Why I'm bullish on the markets, part three. Part three. Ah, man. I should do some videos why I'm bearish on the market. I guarantee those will get a lot more views than why I'm bullish. All right, so the door open, Pablo comes in. All right, so check this out. This is from the Journal of Accounting Research at the University of Chicago, which is basically the preeminent accounting research. Well, let me show you. One sec. Is the arguably the top academic accounting journal in the world. Now we're going to get into this here in just a second, but so I'm reading this, and just this is from the abstract. All right, so University of Chicago, Milton Friedman, everyone's like University of Chicago, the Chicago boys, and anyway, so check this out. This is the abstract. This study uses a comprehensive panel of tax returns to examine the financial reporting choices of medium to large U.S. private firms. All right, so why would this make me bullish on the markets? All right, so this is going to look at a financial reporting of medium to large U.S. private firms, a setting that controls over $9 trillion in capital, vastly outnumbering public U.S. firms across all industries, and yet has no financial reporting mandates. Did you hear that? Private, medium to large private U.S. firms controls over $9 trillion in assets and capital, which vastly outnumbers public U.S. firms. What does that tell you? Supply and demand. The supply of publicly traded equities is dropping. It's kind of like the supply of your neighborhood housing. If the number of houses for sale starts going down, what does that do to prices? As long as demand stays the same, the prices go up. If demand drops, if demand goes up, I should say, and the supply goes down, the prices go up even more. As people are putting money into the markets, more and more money's going in. The demand is going up, and the supply is doing what now? Is going down, because more and more firms are going private because of accounting. Look right here. Yet these companies have no financial reporting mandates because they're not publicly traded. Thus, inherently, there's huge incentives to take a company private. The financial reporting is lessened distinctly, deeply. So less supply of publicly traded companies for us to invest in, more demand simply by default. Because you're like, man, I got fewer and fewer companies to invest in, and inherently the demand for what's remaining is going to drive the prices up. So check this out. Here's the Wilshire 5000. You'd think the Wilshire 5000 represented 5,000 U.S. stocks, right? This is what we call the total stock index. And this is from 2019. I have no idea what it is now, but I can assume it's only gotten, I say worse or better, depending how you look at it. The Wilshire 5000 is the broadest index in the United States, covering every stock listed on the New York Stock Exchange, NASDAQ, and American Exchange. When the index was launched back in 1974, it included 5,000 stocks, hence the name. The Wilshire 5000 was never limited to 5,000 stocks, all right? And so what we see here is right here, as the stock market boomed in the 1990s, the Wilshire 5000 grew in size to 7,500 companies. Then membership has shrunk, declining to 5,000 in 2005, and since then the Wilshire 5000 has included less than 5,000 companies, and as of 2019, it was all the way down to, it's down to 3,486 companies. That means the number of companies that are included in the Wilshire 5000 has shrunk by 54%. 54%! So what does that mean? Is the number of people buying shares shrunk by 54%? Of course not. So those dollars are now, this is inflation right here. Too much money chasing too few goods. Again, the too few goods is the aspect here, not the too much money. This is Milton Friedman going back to the University of Chicago. Too few goods. The supply has gone from 7,500 to 3,500. I mean, come on, think about that. And if we just go back to what the Chicago boys at the University of Chicago said, right here, has no financial reporting mandates. So you take a firm private so you can get around the SEC. And look, I don't like the SEC any more than anybody else does. But I mean, the facts are that you have to report quarterly. This whole thing about quarterly reporting, the whole thing is nuts. You got to do conference calls. Just this, the regulation is insanity, man. It's going to drive more and more companies private, which means there's less and less supply of publicly traded companies. And the publicly traded companies that are left standing are going to get all the money because there's no one else to invest in. That's why I'm bullish. Now, I just want to share with you part 2 of this here. My man right here, Carl Stack Academia. You should subscribe to him on Substack. The point about this article is that he was, let's just use this is from Scott Adams. The test data doesn't support our plan. And this guy says, we know our plan is brilliant, so just adjust the data to support it. You mean falsify the data? Let's not get hung up on the definition of things. Yeah. The point being is, right, this guy says the problem is the data doesn't exist. Hold on a second right here. There's some data in here in terms of how they evaluate some of the number crunching that's suspect at least. And I'll leave that and I'll put the link in the show notes for you. If you don't trust academia, my man is this guy Carl Stack is absolutely the way to go. Fabricated data swept under the rug at the University of Chicago. He's got right here. Leaked report shows Harvard professor fabricated data. I don't know who Lisa Cook is. Tenure packet, plagiarism at Yale School of Management. This guy kicks butt. Love this guy. So let me show you real quick. Just posted this 18 hours ago. Updated on fabricated accounting data. 3 months ago, I reported on a data set that doesn't exist. Yeah, we talked about that. And University of Chicago was tasked to investigate University of Chicago. Anyway, I find that funny. But and all these people say, why would they lie? Because they can, man. Never heard of publish or perish? All right. Anyway, I don't know. Who knows what's going on in academia? I don't trust these guys as far as I could kick them. You should not either. But we do know for a fact that the Wilshire 5,000 isn't 5,000 stocks, is less than that, whereas 20 years ago is almost twice that. Thus, that's why I'm bullish. All right, love your thoughts. We'll see you